Hello, you lovely people. Welcome to chapter number 10. It's about budgeting, fixed and flexible budget. Well, we're going to learn a little bit of variance analysis, planning and control, fixed and flexible budget, all about in this video. There will be only a couple of videos, one on fixed and flexible budget with some examples, and next one would be activities. Introduction. What do you mean by budget? Budget is the financial and quantitative plan of operations for a forthcoming period. Basically, budget is the financial expression of your plan. Financial expression of your plan, or like you had a plan, you're gonna go and watch a movie. There is no financial involvement yet, but to watch the movie you need to take a Uber, could be, or maybe TFL, and then you went to O2 to enjoy the movie. You bought a ticket, you spent some money there, then you bought a popcorn, you spent some money there. So this is known as budgeting. Obviously budgeting can go well different compared to actual. When budgeting is different than actual, we call it variance. Yeah, variance. That's what we're going to learn in this particular chapter. And there could be positive variance, there could be negative variance. Positive means favorable, and negative means adverse variances. We determine the objective, set budget, then we work in real life, then we compare the budget. Let's check out the fixed and flexible budget. Fixed budget is also known as master budget. Fixed. And flexible budget, which varies based on the level of activity. Let's go with the illustration number 1. Fixed budget. Martin Engineering prepares detailed budgets for each quarter of the year. The budget for quarter number 4, 2018 was set below. Look at this. Sales given 40,000 for 1,000 units. Then material, labor, overhead, all minus equals to, you get gross profit, and minus another overhead. This is, if this is production overhead, this is going to be non-production overhead, like selling and admin and finance related indirect costs, which you take away, you get equals to operating profit. Okay, so that is our fixed budget. Actual, we're going to check out the actual, what is happening. This is our budget, wasn't it? Yeah, budget. And this is the actual. Now, budget we have seen, according to our budget, operating profit is 7,000. But actually, what happened? 1,200 units we produced and sold. And the selling price is this. Material, labor, overhead is different. You get gross profit different, and another overhead is different. And you got a profit slightly higher, £40 higher. But do you think these two comparisons, like comparing all these budgeted were held for 1,000 units, wasn't it? But actually you produced 1,200 units and your actual outputs are different. Should not you have a budget for 1,200 units? Answer is yes, you should have a budget for 1,200 units, and that budget you should compare with actual. Now, this should have is known as flexible budget. Yeah, flexible budget. Before going into the flexible budget, let's compare our master budget or fixed budget. Master or fixed. Fixed budget comparing with actual. Fixed budget, look at this. Sales, we thought 40,000 we're going to sell, but we sold more, 5,600. We call it favorable. Material, 10,000, but it costed you more. Obviously, you're producing more units, should cost you more. So because it is costing us more, we said it is an adverse. Then labor, it is costing more by 1,800, adverse. 3,000 is the production, but 3,200 is the actual, 200 adverse. Once we minus these things, we get a favorable. Yeah, budgeted gross profit was 15,000 and actual gross profit 16,120. So 11,120 is favorable. How about the overheads? Overhead budgeted was 8,000 and actual is 9,080. So 1,080 is adverse. Once we compare from top to bottom, our actual profit is 7,040 and budgeted profit was 7,000. So we said 40 favorable. But people, yet again, do you think this variance analysis is worthy? I don't think so, and we don't say so. Rather, we say we should have a budget for 1200 units. Yeah, we should have a budget for 1200 units. And this should be based on the fixed budget. How do you do it? Just stay focused. There are some fixed budget and flexible budget. Both of these are same. Why do you do the flexible budget? Because at different level of activities, we need to work it out for planning, control, and decision making. Yeah, even they are just telling us here, when used within this context of budgetary control, flexible budget is referred as fixed budget, flexed budget. Flexible and flex is the same thing. Yeah, flexible and flex is the same thing. Now, let's read this illustration number 2 carefully. It's the same question as fixed budget from the top, but they said some clauses here. You need to read these clauses in the exam, in the question very carefully. The details of the cost behavior. Clauses means points. Material cost is totally variable, which varies with level of activity. How about the labor? Each operative can only produce 250 units, yeah, each quarter. The cost of each operative is 3,000 people. You need to pay little attention here. Each operative can only produce 250 units. So how many units? 1,000 units they're producing. So 1,000 divided by 250, if you do 4, isn't it? Yeah, 1,000 divided by 250. We need 4 operatives. 4. The meaning of this line is each operative means one person can produce 250 units. So to produce 1,000 units, we need 4 operatives. And what did they say regarding those operatives' salary? Each quarter, the cost of each operative is 3,000 each quarter. 3,000. So 4 times by labor. 4 people needed, isn't it? 4 times by 3,000. That gives us 12,000. So we need to keep it in our head, that one. Production overhead is fixed, totally fixed. Non-production overhead, general expenses are made up of the budgeted. Yet again, it is fixed. Yeah. So this 3,000 is fixed. This 8,000 is fixed as well. Let's keep going on then. We need to flex our budget. Make the budget flexible. Make the budget flexible. Now, how do you do it? Budgeted was 1,000 units. Actual was 1,200 units. Yeah. So we're gonna divide by 1,000, multiply by 1,200. That would give us the answer here. Look at this. Budgeted selling price 40,000 divided by 1,000. That was our budgeted, wasn't it? 40 per unit. So that 40 times by 1,200, we're gonna get a flexible budget. It should have valued. Should have. Or should be valued, shouldn't it? Yeah. So budgeted cost per unit of sales is 40. So for 1,200 units, budgeted selling price per unit should be 40 times 1,200, 48,000. How about the material cost? It was fully variable. 10,000 is the cost. How do you get the 10,000 from the fixed budget? Look at this, 10,000. 10,000 divided by 1,000, shouldn't it? Yeah. And you get £10 per unit. For 1,200 unit, the budget should have been 12,000. How about the labor? You see, I said we need 4 operatives. Yeah, 1,000 divided by units divided by 250, you get 4 operatives. But for 1,200 units, if you divide it by 250, you get 5 operatives. 5. To produce 1,200 units, you need 5 operatives. And each operatives, we need to pay £3,000, right? So 15,000 is the labor cost. That is being shown here. 5 times by 3, you get 15,000. And fixed cost remains fixed. Whether you produce 1,000 units, 1,200 units, 12,000 units, no matter. Your production overhead is fixed. Your general overhead is fixed. Yep. So these two will be unchanged in our flexible budget. This is our flexible budget now. We're going to compare flexible budget with actual. This budget is basically flexible budget. Flexible budget, we got to compare with the actual. Now, actual is given in the question. Budget is given as well. We had to do the flexible budget. We had to do this 48,000, 12,000, 15,000. 3 and 8 is there, but we had to do it. We have done it. Now let's compare it. 48,000 should have been the flexible budget for the sales of 1,200, but actual sales is 45,600. Adverse, not good. Sales are lower. If you sell less, you are sad. Yeah. Cost, look at the cost. According to your budget, it should have costed you 12,000, but actually it cost you 12,480. 480 bad, because if it cost you more, it's bad again. Yeah. And labor, according to your budget, it should cost you 15,000, but it costed you 13,800. It cost you less, which is very good. The less it cost you, the better. 1,200 means favorable. Production overhead, fixed or flexible, both going to be same because it is unchanged. But actual can be anything. This time it's more, 200 more adverse. Once we do all these things, our gross profit according to flexible budget should have been 18,000, but according to actual it is 16,120, adverse by 1880. General expenses 8,000, this is fixed as well, and that's why in the flexible budget is fixed, same thing, but actually it's more by 1,080, adverse. And once you deduct it, you get operating profit according to budget should be 10,000, but actually it's way less, 7,040. Look at this. This is actually adverse. When we compared fixed with actual budget, we found a profit of 40, right? Look at this. We found a profit of 40 because we compared fixed with actual. Yeah. This budget... let me take another color pen here. This budget is for what? 1,000 units, but actually it is 1,200 units being produced. So we should have a budget for 1,200 units. Then that should have been compared with this actual, shouldn't it? That is being done in flexible budget. We are flexing our budget based on the clauses or information given. Once we flexed, these are all the workings. We got the flexible budget. This is our flexible budget. We put the flexible budget here and compare with the actual to get our variances, and that's our correct variance. Well, that's all from this video. Check out our next video on 3 activities, activity 1, 2 and 3. Till then, goodbye.